think about renting a home. That's the comparison I like to make, is that when you rent a home, you're living in the home, you get the benefits of the home. But when your rent agreement expires and you're no longer renting that home, you don't have anything to show for it. Well, term life insurance is the same thing, right? You're covering yourself for a period of time, 10 years, 20 years, 30 years. If you're still living at the end of that period of time, there's nothing to show for it, but you had the protection along the way in case of a premature passing.
Right. I've also heard the term temporary life insurance. Do you think that's on point?
That's correct.
Term life, temporary life, death benefit life. You guys can kind of think of it that way. So we'll jump into whole life insurance. By definition, it's actually probably the most long-standing life insurance that there is. Before they invented some of these other products, there was whole life insurance, and it's really a permanent life insurance policy that offers a level premium and permanent death benefit. And we'll talk about some more things that you probably aren't aware that it offers. So, Barry, you want to jump in on that?
Yep. From the home perspective, this is like buying a home where you have an asset and you're building equity. That's the way you think about whole life insurance. It is an asset, you're building equity, which we call cash value. The great thing about whole life is the death benefit doesn't go away. So it doesn't matter if you pass away at 40 or 60 or 80 or 110, that death benefit is permanent. It's always there.
And then just speaking as a planner for a second, as an estate planner, this is pretty huge because you're locking it in for life if provided you're paying the premiums, and you know that it's going to be a part of your plan. That's a powerful aspect of this, where you really don't know that with term. I think it's something that people need to kind of understand the difference.
It's one of the best planning tools out there, Steve, and you know this as an estate planning attorney, that you pay a premium and you're guaranteed that you can leave a larger legacy than what you paid for. That's pretty remarkable, that your dollars are going to be worth more later and you can leave a larger legacy. And then it helps with a bunch of other things that you know about, taxes, state issues, etc. But the side's very powerful.
Definitely. Pros and cons, we're going to dive into term life pros. So of course you can choose your term. So you have 10 years or 20-year term or whatever it is that you think you need. Of course, the premium cost can vary. If you have a longer term, it's going to be a little more expensive because you're locking it in for a period of time. Everybody wants to tout term life because it is a lower premium cost, but we also want to peel back the veil on that a little bit and understand why it's lower, because there's always a reason. Of course, you can BTID. This is our acronym for buy term and invest the difference. We're going to talk a little more about this in the slides to come. And of course, you get the guaranteed death benefit for the duration of the term if the premiums are paid. However, when the term expires, what happens?
Policy goes away. Yep, there's a lapse. Policy goes away. Now, there are some term policies where they'll say you covered for 10 years, but we're going to guarantee your insurability to age 100. The problem that most people don't see is the premiums really get outrageous. You would only do that if you were on your deathbed, more than likely, because the premiums are so outrageous. We're talking 10 times.
You raise a great point. So premiums with whole life start out, you might consider them high, and they're going to remain level. Eventually, they're not going to seem very high in later years, or they disappear completely if you're doing limited pay or whatever, correct?
That's correct. And you bring up another point that I think about, which is if you insured your entire life just with term insurance, you would pay more in premium at the end of the day. Whereas with whole life insurance, although the premium might be higher initially, you'll pay less for whole life. It's actually the least expensive form of life insurance in the industry, because the premiums are level, they never increase, and you're covered for the duration of your entire life until you pass away.
Well, that's probably shocking some listeners, thinking that usually a lot of the criticism you might hear is that whole life is expensive. And you're saying, Barry, when you really run the numbers, that you get a different picture when you consider the lifelong cost of a term policy.
That's correct. And see, there is misinformation out there that's put forth by these financial pundits, so-called gurus. When you retire, you don't need term insurance. Or financial advisors that say, yeah, we're going to insure you with term insurance to the age of 65. But think what happens in someone's mind, either consciously or subconsciously, if their term insurance goes away and they lose $1 million or $2 or $3 million of death benefit, what happens? There's so much pressure now on their assets to perform because they literally lost $1 million to $3 million or whatever the death benefit amount is, that will no longer be going to family, be going to legacy planning. Whereas with a permanent policy, they now have the freedom to spend and enjoy all their assets, knowing that their death benefit will come in and replace that money that they've spent in retirement. So what I've seen in my 20 years of planning and helping clients across the country is term insurance, when it expires, it puts a burden on a person's financial portfolio. And sometimes they don't make the best decisions when that happens.
Wow, so that's huge. That's something that I really hope people listening will let sink in for a few minutes, that you're really trading off something that will basically lapse, right? So for an immediate low cost when you're young and able to earn and all these things in your top earning years, you're going less expensive, but you're trading that, trading something that will lapse and then put a lot of pressure on you and your estate in later years, is what you're saying.
That's
in more vulnerable years.
That's correct.
As a planner, that one really resonates. Very appreciate you bringing it up.
Yeah.
So term life cons, of course, we were talking about how term expires, no cash value accrual in a term policy. We're going to talk a little bit about cash value because that goes to a lot of the things that Barry just mentioned. You have the death benefit, but you also have cash value that can be used during the lifetime of the person when you have a whole life policy. We're also going to talk about the BTID idea and how, even though it's touted regularly by, I guess, who we can call financial entertainers, I've wrestled with it a lot as a planner because I think it does put people in bad situations. And also it may offer less benefit than what's touted when you really break down the invest the difference part of it. All right. And of course, I do want to point out the death benefit in a term policy. Statistically, they're much more often not used or not cashed in on than used. I don't know, Barry, if you have the statistics on that.
Well, it's less than 2% of term insurance ever pays a death benefit. So it is a great profit center for insurance companies. Now, I'm an advisor. I have term insurance, but I also own multiple whole life policies as well. I still have children at home, so I want to protect what's called my full human life value. So I make up the difference with term insurance, but my whole life policies are growing in death benefit. But you bring up a valid point here with this last bullet point that statistically, yes, there's a lot of terms sold, but 98% of the time or more, it never pays a death benefit.
Right. And I do want to point out, like, one thing I didn't know, and we haven't talked about this yet, but when you start out and if you design, and you do a lot of these, I know, Barry, every day, design a cash value or a high cash value policy. Sometimes you're blending term in the early years for those people in order to give them a solid death benefit at a bit of a lower cost. Do you want to unpack that a little?
What a great point. You're exactly right. The design that I love to use that's best for clients is a blend of both. We have the whole life, we have term coming together. We grow cash value more rapidly, increases the death benefit, increases the MEC limit, which others can learn about on different webinars. That design that I just described is the best of both worlds. And then not only is a client paying less for that type of policy, they're getting a better policy. It's pretty interesting to see those numbers.
Right. And just to kind of promote Barry for a second, guys, obviously you have to have somebody that knows how to design these policies. You have to blend right. You have to use paid up additions. And for any of you guys listening, you don't know what these terms are, we've got other webinars that you can find easily at InsuranceandEstates.com. Talk about paid up additions, talk about how these policies are designed and the living benefits of these policies. So just want you guys to be aware of that. And a lot of agents aren't advisors and they wouldn't really know where to begin in terms of designing these things. I encourage you on that. So whole life pros, we talked about some of these benefits, but really want to unpack them. Guaranteed premium for life. So that's a cost that you have that, again, many might consider it more expensive going in, but it can drop off depending on how you design the policy, or it's going to remain level, which is really going to be less. When you consider inflation in these things, that cost is fixed, which is a really unique aspect of whole life.
And Steve, there are some myths out there that if you lock into a whole life policy, you have to pay a premium your entire life. That isn't true all the time. Matter of fact, in the designs I use, my clients are usually done funding in 10, 20, 30 years, depends on how old they are, but usually, not past 65. And that's really powerful for someone because they say, I'm done working at 65 or whatever that age might be. I don't want to keep paying premiums. Well, we can show them a design where the premiums are done, yet their death benefit can still be growing. Their cash value can still be growing, even though they're not putting any more money into the plan. So I wanted to dispel that myth. If you have whole life, it doesn't mean you have to pay the premium your whole life.
In fact, you and I did a webinar on it, on the limited pay life insurance, right? That's the technical term that we refer to a premium basically being paid off in a period of years.
That's right.
All right. So I encourage you guys to check out that webinar, Limited Pay Whole Life, as well. We actually touched on most of these tax advantages. And I just said, in here, we have an asset that can be leveraged. This is unique to whole life. And it can be realized with other kinds of cash value life insurance, but particularly whole life, because it's such a solid asset that's going to grow guaranteed cash value. So this is building something, and I sometimes equate it to a piece of real estate. Barry, you like to talk about it like you're buying a house or something. Eventually you can use the equity there as an asset that you can leverage, which is a huge strategy that we love to talk about.
Wonderful. Love it.
So, the initial expense is going to be more than term life. And some people think that whole life has a slow growth track. However, the other thing that we often talk about is that, when you do high cash value designs, you can grow cash value a lot faster than traditionally designed whole life insurance. So that gets into paid up additions and base premium and these kind of things. And so I encourage people listening to check out the paid up additions webinar as well. It will unpack that whole area of paid up additions, which is really exciting when it comes to whole life policy advantages. All right, Barry. Well, I'm going to invite you to jump in. You're probably chomping at the bit with this one. Buy term and invest the difference. We were joking before we started here that we could probably talk for an hour and a half about what the issues are with this recommendation. You have to understand that when financial advisors say this, they're missing about 90% of what's relevant about it. For one, it's boilerplate advice that you're giving to everybody. As a planner, I'm speaking as an estate planner. You can't do that. And there's also a lot of liberty taken with this idea, right? There's things about what would you actually be investing in? What are you trading off? Things like that. Barry, you have some thoughts?
The overall myth of buy term and invest the difference is that, one, a lot of people don't invest the difference. They say they're going to, but they don't. And so that money gets spent, therefore they're not growing their retirement like they should be. The other thing to realize, and we spoke about this a little bit earlier, is when that term insurance does expire, now there's more pressure on the investments to perform. And the individual might be left feeling like they're a little scared, concerned, worried about spending and enjoying that money while they're alive because they would like to leave a legacy, or they don't want to run out of money. The other problem with buy term and invest the difference is when I see numbers portrayed by a financial planner, they're often exaggerated. We see this here on the third item, that they're greatly exaggerating returns. For example, some of these financial gurus or so-called financial gurus will talk about if you buy term and invest the difference, you can earn 12% in your mutual funds. Well, first off, that isn't even possible on a consistent basis. Yes, the market might earn 12 or 20 or 30% in a given year, but it will also lose 10 or 20 or 30% in a given year. We call this the sequence of returns. When you look at sequence of returns, and I'm going to use an example, the S&P 500, it's the best of the best index out there. People love to invest in the S&P 500. Well, Steve, the 20-year history of that index has only returned 5.6%. That's it. And then you have to take out taxes and fees on top of that. So you're looking at maybe a 2 to 3% net return. So if you're hearing from your financial advisor or one of these so-called gurus that you're going to earn 12% in your mutual funds, it is an exaggeration. Looks great on paper, but in reality, the market has never done that consistently. So we have to be concerned where the dollars be invested and what do the sequence of returns really bring you at the end of the day. What I love about the whole life cash value insurance is that guaranteed growth, tax-free use of money. And when we calculate fees in a whole life contract are about 10 times less than what someone would pay in an outside investment, like we're talking about here with buying term and investing the difference.
That really blows a hole in the BTID, just when you consider the true return that you would get in these S&P kinds of investments, which is really the type of investment that the financial entertainers are talking about and promoting.
That's right. And one of the gentlemen I like to refer to, Jack Bogle, okay, CEO of Vanguard, he started Vanguard with the idea of helping people invest in low cost, low fee index funds. But even he'll tell you, he's been interviewed multiple times, a 2% management fee or fees inside of the account that can add up to 2% will erode more than 50% of someone's portfolio. And you think about that. How can a small 2% fee erode half of my money? When you do the math and the sequence of returns, like we've talked about, what he's stating is true. And so here we have a true guru in the industry who knows his stuff that's telling us even a 2% fee can really be dangerous when it comes to the amount of money that you're going to wind up with in the end. It's not what most people think. And we've got quite a few webinars where I go through calculators to show this in real life. It's not just opinion, but I prove it out mathematically. And then you can see for yourself. So definitely check out the other webinars where we run through the numbers and the calculations. And maybe I'll say this, when we're talking about buy term and invest the difference, the net return for most people in a high cash value whole life policy is around 5%. That's 5% net tax free. Well, to earn 5% net in a market-based investment, you have to earn 9 to 10%, depending on your tax bracket, but you have to earn that 9 to 10%, Steve, every year. That's no losing year, which again, doesn't happen in the market. So when you consider if I can net 5% tax-free, that's remarkable with no risk, no worry about losing money. I have access to my liquid cash anytime I want. I have more peace of mind. I have more certainty and predictability. It's a remarkable rate of return when you compare it side by side with a market-based investment.
It's huge. I mean, when you consider the tax hit on the touted investments, I'll just refer to it that way, that's huge. And really, this is why, guys, that the big institutional players that we often talk about, why they have large portfolios of whole life insurance.
Yep. Isn't that funny? That the very companies that are selling the 401ks, the IRAs, and the mutual funds are doing the exact opposite with their own money, that they're buying whole life insurance themselves. It's a valid point, and they'll never talk about it because they want to make sure that they have assets under management where they're earning those fees. And a biggie, you hit it, is taxes. A lot of these investments that people go into are tax deferred. Well, think about it. If you defer your invested dollars for 20, 30, 40 years, one, do you have any idea what future tax rates will be? No. And two,
probably higher.
Probably higher. That's exactly right. So here you're hoarding cash. Financial institutions in Wall Street are getting wealthy off of your money. And then when you are ready to take it out, one, you may have a much lower return than you thought and a smaller bucket of money than you thought, and potentially 100% taxable at maybe a higher tax rate. It doesn't sound very appealing to me.
Right. All these things are missed, right? When we're in a world of lots of sound bites. And when we get these sound bites, buy term and invest the difference, and all these things not being considered, it's actually tragic when I think about it.
It is. And what I really don't like are these financial pundits making blanket statements
Hmm.
that could help someone, but also hurt the majority of people. Because these types of plans or this type of planning, we want it to be individualized. We want it to be personalized. We don't want anyone hearing a blanket statement and thinking, oh, I always have to do this or I always have to do that. No, let's look at your goals. Let's look at this on an individual basis. But unfortunately, that's how a lot of financial advice is really put forth. Blanket statements doing harm to a lot of people.
Mm. Well said. How do you know if whole life is right for you? Barry, we've got this list here. Do you want to speak to that just in a way that you might speak to one of your clients?
I had a call just this morning where I said to the client, let's put your numbers together, and before you make a final decision, we'll review it. It's always important first to see your own numbers. That's where I would start. Consider a dollar amount you would want to put towards a whole life policy and look at the numbers. Once you see the numbers, you see the asset, you see the cash value growing, the death benefit, the legacy planning, I think you'll get excited about it. But that would be the first step.
Awesome. All these things, you've got a number of ways that you can know. And of course, like anything else, this is something that needs to be right for you. We encourage you to look at these other webinars, to do the research. We put together an amazing amount of information at InsuranceandEstates.com. And with that, we thank you guys for joining us. If you're ready for a personal discussion on any of these things to see how the numbers actually would work for you, you can connect with Barry by just filling a questionnaire by clicking the button below the video. Do a quick questionnaire and you'll be on your way to scheduling and getting the insight individually that you're looking for. So we're excited for you. Thanks for joining us. Barry, thanks for jumping in and all of your insight. We appreciate it. We'll have more topics in the future for you guys as well.